Market Catalyst. I'm Julie Hyman. Here's what we're watching today. First up, Oracle shares erase $100 billion in value. We'll dig into the results amid growing fears of an AI bubble. Plus, division in the Fed. Silent dissenters emerge amid a widening split in the central bank. We'll have details on that as well. And how are investors weighing both the rate cuts and the AI trade? We'll bring you a new survey on investor sentiment. Let's get a check on the major averages. First of all, here this morning, we are seeing a mixed picture. The Dow right now is up, and up almost 200 points, about 0.4%. But the S&P 500 pulling back from a near record close yesterday, down about 0.75%. And the Nasdaq is down the most, as you might imagine, about 1.4%. Why is the Nasdaq down the most? Well, it's because of Oracle. You see here, those shares are pulling back by some 15%. And the stakes are really interesting going into this report. Now, Oracle is still higher on the year, but as you can see, it's had this sharp pullback from its highs of the year there, when Oracle is down by more than 30%, well more than 30% now with the declines that we have seen in today's session. A lot of questions about funding for Oracle, about its spending going forward. Now, as we know, all of the hyperscalers are spending right now. It's just that Oracle has not as much cash as the others, and in fact is taking on debt, and did not say anything last night that seemed to really reassure investors on that front. We are going to dig more into Oracle in the next hour with Gil Luria of D.A. Davidson, who's been raising a lot of these questions. But for now, we're definitely seeing it weigh on the major averages. Cisco, IBM are another couple of the stocks that are trading lower. But even if you broaden it out and look at the non-sort of software group, you've got Broadcom trading lower ahead of its numbers, NVIDIA off by 3.7%, Google and Apple and Amazon, all of them are lower, Tesla lower as well. And we told you earlier what's going on with Disney, that it has now signed a new agreement with OpenAI, going to equal weight this so we can find Disney here. Disney is up about 1.6% here. So it's not seeing a huge lift in today's session, but a little bit of lift as it signed this new agreement with OpenAI to invest $1 billion into OpenAI and for them to partner on content here that is created by AI. So an interesting move on the part of Disney. So a lot to watch on that front this morning. Just want to go back quickly to some of our other assets that we watch outside of stocks, because given that we are now a day out from that Fed cut, I wanted to take a look at what's going on with yield. So there was some question here about not just what yields are going to do in the immediate aftermath of the Fed, but what they're going to do going into next year. Because we have seen, even though the Fed was expected to cut, we had been seeing yields come a little bit higher. Not so today. We see 6 basis points decline in the 10-year yield. And if you look over, let's say, quarter to date, let's take it, we've seen some volatility here, certainly in the 10-year yield, but a little bit of an increase in yields going into that cut. So it'll be interesting to see how that develops next year as well. And let's talk more about the outlook for the Federal Reserve, shall we? Because that divided central bank cut interest rates by a quarter point, marking the third cut this year. 3 voting members dissented for the first time in 6 years, creating an uncertain path forward. They dissented on either side. Stephen Myron wanted to cut more. Goolsbee and Schmid wanted to not cut. And joining me now to talk more about this is Tomasz Honig, Mercatus Center Distinguished Senior Fellow and former Kansas City Federal Reserve Bank President and CEO. Tom, thank you so much for being here.
Sure.
It seems as though the committee is growing more concerned about making some sort of policy mistake. And indeed, we don't have a lot of public data right now because the government shut down. And a lot of economists I'm speaking with are, the path is not very clear. So do you think that the risk is high of a policy mistake?
Well, I think this is, yes, this is very close to a policy mistake. Only time will tell. But I would say that the reason there is a split is that there is a lot of information suggesting the economy is in a stable growth path. Also, as you look forward, the recent tax legislation from this past year takes effect. There's a lot of stimulus in the investment side from that tax bill. That is the expensing of investments. It makes it more attractive to invest. That'll stimulate the economy. And so you have this momentum for growth going forward. And then the other side of it is, well, the employment numbers haven't been as strong as we would like. And of course, that's mixed by immigration as well as demand overall. But still, the unemployment rate is fairly low. So you have that factor coming into it. So you have these divisions. And one final thing that I think is a bit of a surprise to me was the size of the announcement in terms of their re-engaging in asset purchases of government securities to the level of 40 billion per month. That's a big switch from quantitative tightening and very stimulative in and of itself, depending on how they manage that. And because if you think about 40 billion a month is 480 billion a year, that's half a trillion. That's a lot of money base money coming into the system. So yeah, with all this going on, there's going to be a lot of disagreement within that committee.
So what do you think then is the outlook for rates going into next year, particularly given that there's going to be a change in leadership?
Well, that's a hard question because, number one, the Fed has already eased a fair amount, and whether you need to ease further is an open question, especially given what I call the quantitative easing move as well. But there's going to be a lot of pressure to ease because the government debt is so large. It's 38 trillion, but the deficit is almost 2 trillion, despite the revenues coming in from the tariffs. So you have all this pressure coming towards the Fed to accommodate this increase in debt. That means continuing to keep rates suppressed going forward. So I'd say it's going to be a very difficult year to predict what the Fed's going to do, with, first of all, conditions being such that you should, at least you could make a good case for pausing, and then a lot of pressure, though, to continue the stimulus and to continue to fund the growing government debt. And how that plays out is anyone's guess, and is a big part, I think, in the choice of who succeeds Jay Powell.
Well, and on that front, I mean, Powell, I think it's fair to say, is pretty respected by the members of the FOMC. And even he had more trouble this time corralling folks, right? We had, in addition to those public dissents, we also had the non-voting members who, quote unquote, dissented, who wouldn't have voted this way. So what does that imply about how difficult it could be for a chair who maybe doesn't have the same stature amongst the committee?
Well, that would be a problem, because that means, well, it would be a problem in the sense that the chair usually controls the outcome of the meeting. And if that were to be challenged by close votes, that happened in the past, in fact, with Paul Volcker for a while. So that makes it more difficult for the markets to understand what might happen. And that could be, that could hurt the economy. So I think the president, who is in the process of choosing right now, will choose carefully, both in terms of what he would like to see, but also in terms of the market respecting that individual. The candidates that are out there right now are all well recognized in terms of their knowledge of the markets, or their knowledge of the monetary policy. Which of those will be chosen and how that person is received. For example, the most important thing that will happen after the new chairman is chosen will be their first speech, because everyone will be looking for what the tone of that speech is, because that will, I think, indicate how the FOMC will be led going forward from there. And that's a big part of the market's curiosity right now and concern more broadly.
Do you have a favorite? Do you have a pick who you think should be the next Fed chair pick?
No, I don't. I have those 5 candidates. They're all qualified, and the reason I don't have a pick is I don't know how they'll react under President Trump. They all have good credentials, but they're going to be under a lot of pressure, and that's why I'm going to wait and see how whoever's chosen, how that individual confronts the challenges ahead early in their new tenure. So. No, I don't have a pick. I'm just kind of waiting and watching like everyone else.
Yeah. Finally, Tomasz, I want to ask you on a separate front. This morning, Yahoo Finance has confirmed that Treasury Secretary Scott Bessent is out with a letter. In addition to his duties, or as part of his duties, he's also head of the Financial Stability Oversight Council that was formed in the wake of the financial crisis.
Yes.
And he's out with this letter saying it should change its focus and basically kind of look at loosening regulation and looking at where things can become what he says is less onerous. Now, you weren't just on the Fed, you were with the FDIC as well. So you have a background in financial regulation. What do you think the risks are of this change of approach?
Well, if it's done well, I think it could be very, very productive. I was at the FDIC. I was part of the organization that had to implement the so-called Dodd-Frank bill, which was a heavily new regulation into the banking industry, into the financial industry broadly. It was done very quickly. In some cases, it was done carelessly. So if what he means is that we need to look at the regulations that are in place and we need to make them more functional in a positive way, I would be very supportive of that. I've always argued, when I was vice chair of the FDIC, the regulations should be simple, understandable, and enforceable. As it's now currently, the regulations are highly complex. That's one of the reasons, to be honest with you, that you've seen this very slow, this drop off of new entries into the banking industry. Before Dodd-Frank, before the great financial crisis, there were about 150 new bank charters every year, and that fell to almost 3. And now people will say it's 10 to 15 a year, and that's a big improvement. But the fact of the matter is, given the consolidation going on in the industry, there needs to be more new entrants into this market to serve the public, serve small borrowers adequately or well. And so I think this is a good thing. Now, if it's just wholesale throw everything out, then you'll have more of a chaotic situation, and that would be unhealthy for the financial system. So you have to strike the right balance.
Tom Honig, great to catch up with you. Thank you so much for your perspective.
Thanks for having me.
Coming up, how investors can approach the financial sector, including some takeaways from Apollo CEO Mark Rowan. The Goldman Sachs Financial Services Conference is happening this week with insights from top executives across the private equity landscape. Apollo Global Management CEO Mark Rowan told Yahoo Finance that the industry is in the midst of an evolution.
Internally at Apollo, we do not think there's a need for a cut. There's nothing in the data that tells us, but at the same time, I understand the decision. But longer term, I'm not sure it really matters. I mean, if you think about what's happening, the market is ultimately determining the outcome.
He also talked about the fact that private equity isn't just private equity anymore. They invest in a lot of other stuff. So let's talk about the industry and the biggest takeaways for investors from that Goldman Sachs conference. Alex Blostein is joining us now, Goldman Sachs Research Managing Director in the Financials Group. Alex, thank you so much for being here. So obviously you guys talk to people beyond just private equity. You talk to a broad swath of the asset management industry. What really stood out to you in terms of what you have heard thus far from these executives? What is your top takeaway?
Yeah, of course, and thank you for having me back. So to your point, we hosted the conference over the course of the last 2 days. We had over 100 companies present. Most of them are CEOs. So you really do get really interesting insights about the sector, financial sector broadly, as we sort of start thinking about 2026. A couple of things really stood out to us. Number one, just the resiliency of the U.S. economy. That was a theme that was very loud and clear across a number of different companies, across the banks, across the private markets firms. And if you think about everything the industry has gone through, really in the last 12 months, we had Deliberation Day, you had government shutdown, you had lots of volatility, and through that all, the sentiment around the direction of the U.S. economy continued to be really good. The second one around just the pace of recovery in capital markets, and while there was a lot of enthusiasm about that last year as well, I would say it does feel a lot more tangible and real this time around. We're starting to see a meaningful acceleration of M&A activity. We're starting to see more IPO activity as well. And the recipe for a very robust capital market cycle seemed to be really there as we head into 2026. Third point, I would note, and you mentioned obviously a number of private equity firms, but just the fundraising dynamics and continued growth in all things private markets continues to be a big theme for financial services. And while growth might start to pivot, not just from things like private credit, but hopefully expand back into private equity, we started to hear more favorable things around real estate as well. That will be a continued theme into 2026 also. And the last point I would just make is just around innovation. AI, tokenization, and some of these newer elements that could start to impact financial markets over the years to come.
Alex, all of that sounds positive. Is there anything that folks are worried about at all?
Yeah, so it's a good point. There's not a whole lot of negativity from the conference. I would say the areas of focus has obviously been around private credit, and we could probably spend a whole session on that. But I would say clearly the growth in private credit has been robust. We do not see this as a systemic problem. And I do think that a lot of issues that have been out in the press for the last couple of months have been fairly idiosyncratic. But that clearly continues to be a focus. And losses generally, particularly around direct lending, have been effectively zero. And with any cycle, there are probably going to be some pace of normalization. So how the industry handles that, which again, we're not particularly worried about, but I think that'll remain an important topic. The second element is, of course, growth in the retail or wealth management footprint in this part of the market. The one new sort of piece of information that came out is we've definitely seen a bit of a slowdown in sales for some of the retail direct lending funds in the last month. Redemptions are probably going to pick up a little bit as well. Again, this feels like a normal course of business, and we don't see that as a systemic issue for the space, but that's something that's probably worth watching.
Alex, I'm curious about your thoughts on the stocks, because these stocks have not performed this year, by and large, particularly when you zero in on the private equity firms for the purposes of this conversation. What's been going on there if things are so great? And what's going to make investors kind of come around to the view of the industry and of you, because you've got buy ratings on most of these?
Yeah, we talk about it a lot, as you can imagine. So I think the starting point really matters. So if you look at how well the space has performed in 2024, many of these companies were up 50 to 80%. So I think there's a little bit of a pullback, partially because of how well they've done in the year, in the prior year. Secondly, if you look at the pace of the recovery of the course of 2025, it's definitely been slower. I mean, the dynamics and the market volatility in the first part of the year certainly hasn't been helpful. So you've seen estimates being pushed further out. You did see numbers come down really across the board by, nothing material, a couple of percentage points. And the multiples kind of had to earn their way into where these stocks are today. When we look into 2026, we're finally starting to see numbers stabilize. So after Q3, this was the first quarter where forward estimates actually didn't have to come down. And in many areas, they've actually started to reaccelerate. The fundraising outlook looks really robust. And as one of the points I mentioned earlier, some of this kind of M&A, equity capital markets activity seems to be finally here, right? So we've been advising clients to lean into this sell-off that we've seen in many of these stocks over the course of this year. It feels like it's finally starting to work a bit. The conference hopefully reopened a bit of this capital markets trade over the last couple of days. So we generally remain pretty constructive on the space into 26.
Do you think it's a situation where, you kind of throw a dart and any of them could do well? Or do you think that there are certain in the space that are better poised than others?
No, we definitely think dispersion is a bit of a name of the game here. And while the space broadly should do better in 26 than in 2025, we do lean into some of the more kind of private equity centric firms that will be fundraising more capital in the next 12 months. Also firms that are likely to be beneficiary of this kind of acceleration in the capital markets activity. So I'll give you a few names. So we have gotten a little more constructive on Ares. It's on our conviction list in the last couple of weeks. They're a direct beneficiary of more deployment as M&A cycle picks up. They're obviously a big lender. So the opportunity for them to deploy more capital and grow management fees further looks pretty compelling to us. That's one. I also think when you look at the private equity industry, there are firms, despite of all the negative headlines, are raising a significant amount of capital that is actually larger than their prior funds. So whether it's TPG or KKR, we're seeing real acceleration in fundamentals in those businesses as well. So we don't think it's everything, but there's definitely still parts of the market to make lots of money on, hopefully.
We'll see how 2026 goes. Alex, thank you so much. Appreciate it.
Great. Thanks for having me.
Coming up, we'll take a look at some of today's top trending tickers. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. But today we're focusing in on the top trending ticker on Yahoo Finance, and that's Oracle. The company wiped $100 billion in market value, sinking the most since 2001. And after its latest quarterly results, well, those missed Wall Street's expectations. Now some analysts are resetting their own expectations about where the company is headed. JP Morgan lowered its price target to $230 from $270 and maintained its neutral rating. The analyst said the move was primarily due to a higher execution risk from the multi-year trajectory for its OCI, that's Oracle's cloud infrastructure, plus a pressured free cash flow forecast, which it said was offset by a $4 billion raise to the fiscal year 2027 revenue framework. Next up, we're hearing from TD Cowen because the analyst there lowered its price target to $350 from $400. The analyst said it also remains constructive on the ramp up of Oracle's cloud infrastructure business in the fourth quarter. And on top of that, it thinks further execution can move valuations higher. TD Cowen did maintain its buy rating on the stock. And lastly, let's turn now to Guggenheim's take. The firm actually was optimistic about the stock. It reiterated its buy rating with a $400 price target and Oracle stayed on the firm's best idea list despite that miss that Oracle had in its quarterly results. Now, the firm cited Oracle's increased confidence in applications acceleration, driven by cross-selling and AI-infused tech, plus growing momentum in the AI infrastructure as a service demand environment. And taking a step back, important to note here, there are 36 buy ratings, still 12 holds, and 2 sell ratings on the street. And that average 12-month price target, well, it sits at $308, and so it's trading way below that. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves throughout today's trading session.
Now time for some of today's trending tickers. We're watching Adobe, Ciena, and Vail. First up, Adobe. Shares there sliding after the company's guidance underwhelmed investors. It did deliver an upbeat annual forecast, but investors are seeking signs the company can thrive in the era of AI. Adobe's results from the past fiscal year beat projections, and its CEO says the results reflect its growing importance in the global AI ecosystem. Adobe also announced earlier in the day that its Photoshop and Adobe Acrobat products would be integrated into OpenAI's ChatGPT. The shares are now higher by 2%. Next is Ciena. The networking equipment company posted fiscal fourth quarter earnings and revenue that beat expectations. It also provided upbeat guidance for the coming fiscal year. The results were driven by accelerating demand from cloud customers and expanding opportunities tied to AI infrastructure. And finally, Vail. Shares of the ski resort operator jumping as its results were better than feared. Its first quarter EBITDA loss was better than Wall Street had expected. Analysts also highlighted the company's ski pass sales, with total skier visits up 35% from the prior year. But first quarter revenue missed Wall Street expectations, driven by a decline in season pass sales. The shares up 6%. Coming up, Chevron expanding its business. I talked to the CFO about the company's data center plans and the outlook for oil. Stay tuned. You're watching Market Catalysts. Energy giant Chevron recently came out with new CapEx guidance for 2026 of $18 to $19 billion. This is the same time that the company's been expanding both geographically and kind of in its business, getting a little bit into the data center business. So let's get the latest on Chevron with the Chief Financial Officer, Eimear Bonner, who is here with me in the studio. So good to have you here.
Hey, Julie.
So I want to start actually with something going on in the wider world, and that is the Federal Reserve just cutting interest rates by a quarter point. And given the capital intensity of a business like Chevron's, what happens when you see that kind of cut? How helpful is that to your business?
Well, we're in a long-term business, and so a lot of our contracts have been baked in for the next couple of years, so we're not that exposed actually to some of the inflationary factors. So, you know, we're not significantly impacted by that today, but obviously, you know, we'll watch and see what it does to the things that really impact our business, supply and demand for our products.
So let's talk about the big picture for supply and demand for a minute then, and the macro kind of picture here. When we look at the demand picture for oil in particular, you guys, as you gave your long-term outlook, you're sort of managing around, what, a $60 to $80 per barrel window, if you will. Is that correct?
So we give an outlook at a $70
Okay.
Nominal flat price. So we did our investor day 3 weeks ago, and we updated all of our growth plans at a flat $70 a barrel. And we guided to a number of our metrics. We guided for buybacks, for example, between a $60 and an $80 range. So that's typically what we do when we lay out our plans. We test them at highs and we test them at lows, and we make sure that our portfolio and our growth is resilient and can weather any of the ups and downs and uncertainty that exists in the market, because that's something that we're used to. Markets ebb and flow, and when we think about our business and delivering on our financial priorities, we need to manage through that cycle.
And so if you look at that kind of window now, for example, Macquarie just came out today and said we could see Brent crude prices as low as $50 a barrel in the shorter term, maybe even testing 45, because there's a lot of offshore oil volumes that could be coming onshore and then, kind of inflate supply to some extent. So if you're looking at that kind of picture, whether it's the short term, medium term, longer term, and you're trying to balance those capital needs of paying out those dividends, paying out those share repurchases, how do you balance that? And at a certain point, if it stays towards the lower end of your window, do you say, well, the share repurchases have to suffer, the dividends? Which do you prioritize in that situation?
So we use our long-standing financial priorities, and they've existed for decades, and we use those priorities to guide our decision making. So let me step through them. The first one is the dividend, to grow the dividend, and we've grown that for 38 consecutive years, and that's our commitment to shareholders through highs and lows. And so that's number one. How we do that is through our second priority, and that's investing in the business. And we invest in the business. We've shown increased capital efficiency. It's an area of strategic advantage for Chevron. We've been very disciplined, and our CapEx release that we issued recently is another example of lowering CapEx or guiding to the low end of the range that we shared in our investor day. So that's number two. Third is to maintain a strong balance sheet, and this is where resiliency really matters. Our portfolio has been enhanced with the recent acquisition, and we now have break even. So the cost to cover dividend and CapEx is less than $50 a barrel. So at prices less than $50 a barrel, we can still deliver on the dividend and meet the capital needs for the business. And then if prices are higher and we have excess cash or our balance sheet is stronger, then we move to buybacks. Buybacks is our fourth priority. So, we use the priorities to guide the decision making. And when we find ourselves in low prices, we start at the bottom and say, do we want to adjust the buybacks? And then we work our way up. But the dividend, number one, that's our commitment into perpetuity, and everything else supports that.
I want to talk about how you are spending and on what you are spending. And there's an example this morning. There was the first lease sale of offshore U.S. Gulf plots since 2023. You guys participated in that bidding. So, is that goal to get that increased capacity, increase existing infrastructure, link it to your existing capacity? What's the strategy around that? Yeah,
well, overall, if we look at where we're investing in the business, more than 50% of that business is in the US, and we were really pleased to see that we had a chance to bid a very competitive round in the Gulf of America. That's a cornerstone of a lot of our capability on the operations side. We have facilities there. We've just increased that footprint with the integration of Hess. And so what we're trying to do is look for new acreage to find new exploration prospects, because exploration is a key focus area for us now. And we have a focus on both what's near infrastructure, like in the Gulf of America, great example, but then also in more frontier areas. And that's where we're dedicating CapEx and acquiring new seismic in areas like South America, Western Africa, and Mediterranean. So it really supports our exploration strategy, is to look for ways to replace the barrels that we produce every day through new exploration finds. And then there's also, of course, maximizing the assets that you have already. And I'm talking specifically about the Permian. I know you get excited about technology and sort of how to use technology to optimize what you're getting out of the ground. So talk to me a little bit about what you guys are doing there. Yeah, well, I think Permian is the best example of where, we're deploying technology and scaling it across an unmatched acreage that we have there and seeing results. Last year we spent $5 billion in Permian. This year we'll spend less. Next year our capital is going to be around $3.5 billion. So technology has enabled us to get much more cost efficient, much more capital efficient, and produce more. And we've got a number of things that we have shown visible results through our cocktail of chemicals that we're now applying to the Permian. We've shown already in papers, technical papers, that we can increase recovery by 10%. We're also starting to use that on back end. So the latest asset from Hess that is now integrated into our large shale and tight portfolio, we're also putting that into the reservoirs and look to see results there. So technology is just core. It's what we do, and it's innovation that happens right at the coalface. And it's very exciting. So yeah, I'm really optimistic about what we can deliver. And we haven't built all of that upside into the growth plans that we communicated. Any progress we have not, that would be upside. And then there's AI, and AI is just another area where Permian, given that we have unmatched data, and that's what AI needs, is data. We have unmatched data. That's a strategic advantage that we have, and we're using data, the power of data, the power of AI to change business outcomes there.
Of course, you guys are also tapping into AI and the demand for AI in a new way for Chevron, in that you all are going to be providing power for a data center in West Texas. This is a new thing for you guys. It's going to be happening, I believe you're targeting by 2027. Is that just a template now? Is that something that you want to repeat for other customers? And how aggressively are you working towards that?
Yeah, well, we're very disciplined when it comes to investing in the business. It's part of our DNA. And so we're taking the first step with obviously what we've announced here in West Texas, and we're still working through the details, and we've still a long way to go. The most important thing is that we got to get a contract with the customer, and so we're actively engaging with customers. But the industrial logic is really clear for us. I mean, we operate 5 gigawatts of power around the world today. We need power generation to support the assets that we operate every day. So that's the strength that we have. We've got turbines that are in the queue. So turbines are the things that really are the limiting factor for a lot of these power generation facilities. We have turbines that are coming on the timeline that some of the hyperscalers desire. And 3, the operational know-how coupled with, we've got gas production, and that's the feedstock that we use to generate power. So those 3 things come together. There's just really neat industrial logic for us. And so this is an area that we intend to play in, but we'll be disciplined. We expect double-digit returns. And any power project has to compete with everything else in our portfolio, and we've got more in our portfolio than we typically fund.
How close are you to finding a customer for that project?
Well, we're in, those are commercial sensitive discussions.
Sure.
But, we anticipate making decisions in the first half of 2026.
Okay, look forward to hearing about those. Finally, I want to ask for the latest on Venezuela. This is something that you and I have talked about before. There was a development today where U.S. forces seized a tanker off the coast of Venezuela, a sanctioned tanker. Just another sign of sort of the tensions that are going on. We've talked before about your employees there. You have a large workforce there. So how do you think about, as always, balancing the economic need to have them there running the business with potential dangers? Well,
the safety and security of our folks in Venezuela is first and foremost. So we never compromise that. And to the headline on the boat, we know that that's not our boat, and so we are operating consistent with the U.S. Treasury guidance, so we're from full compliance. The oil is coming to the U.S., it's feeding U.S. refineries, and that's good for the refineries, and it's good for the U.S. So that's the status on Venezuela.
Okay, Emer, thank you so much
for being
here. Great to see you. Appreciate it.
Appreciate it.
Coming up, we'll get the results of a survey of individual investors and how inflation and the specter of an AI bubble are affecting how they buy stocks. Stay tuned. You're watching Market Catalysts. Inflation and the specter of an AI bubble are top of mind for individual investors, but it's not stopping them from buying stocks. That's according to a new survey by Investopedia. Investors also revealed what they would do if they suddenly had an extra $10,000. Joining me at the desk, Caleb Silver, friend of the show, Investopedia editor-in-chief. Good to see you.
Good to be with you.
I find this so interesting. So let's start with what people are most worried about.
Yeah, it's inflation. And they've been worried about inflation or tariffs or some combination therein all year for good reason. But that's the thing that is on their mind. It's on their mind because rising prices kind of fly in the face of the fact that the stock market keeps going up. If we're feeling not that great about our personal finances, how could things be so good in the stock market? And I think we've all been asking ourselves that question as well. So they're a little bit worried about that. They're worried about bubbles, especially in their favorite stocks, but that hasn't stopped them. They've been relentless all year long.
Okay, that's what's so interesting to me. That to me is probably the most interesting finding of this study. They think that AI might be in a bubble, but they're still buying. Are they buying? Are they adding to positions, or are they just holding on?
Yeah, they've been buying and holding, and they've been buying and holding for years. And even in November, during that pullback, I was looking at the stacks, the Schwab activity report, they were buying aggressively the biggest stocks. And some of the biggest stocks we know were falling 15, 20, 25%. Their favorite stocks. We always ask them, what are your top 10 holdings? And we always ask them, what stock would you buy today and hold for the next 10 years? Guess what, Julie? It's the same stocks they've been buying and holding for the last 5 years, except for a couple of new additions. Like Palantir.
Most of that stuff has worked for them, right?
It's working, and they own a lot of it, so it's really hard for them to think about divorcing themselves from those positions and transferring into a different sector.
Okay, so we have like your word cloud of some of these.
Yeah, stock cloud, I love it.
In stock cloud, NVIDIA, Apple, Microsoft. I mean, the one that stands out to me actually is not doing as well as Berkshire, which was
Berkshire Hathaway.
I believe was on. Oh, this is the one they would hold for the next 10
buy
years.
and hold for the next 10, but the one they hold and own now, Berkshire Hathaway, is on that list. We know we have investors 18 to 80 on Investopedia, probably an older investor that's been getting into Berkshire over the years. Hard to think about breaking up with that stock if you've been an owner for a very long time, but we know the Buffett premium's been slipping a little bit since he announced his retirement back in May. That said, when you look at that list, it looks like the top of the S&P 500 or maybe the top of the NASDAQ 100 plus a couple financial stocks, and they are loyal to this group of stocks.
Now, you mentioned that there's a wide range of age, but I do wonder if it's the younger investors who are, even if they're worried about the bubble, are still investing because they have a lot of their investing lives ahead of them. Is there a way of knowing that?
And we can break down the age demographics. We know where these people live, and we know how much they have to invest. So there's some of that, but there's also the fact that I think younger investors have gotten used to the fact that dips get recovered very quickly, and they should buy them. Otherwise, they're going to miss the opportunity to own a stock at a cheaper price. So they have watched that little mini dip correction, whatever you want to call it, in November, 5%. The snapback from that was one of the fastest in history. The bear market we had, obviously, during the pandemic, one of the fastest in history. So the cycles are moving quickly, and they don't want to be left out of gains.
Yes, although we know historically it doesn't always work out that way. But, to your point, it definitely has in more recent years. And then that $10,000 that we talked about, what would they do with that?
Yeah, so we always ask them, if you had an extra $10,000 to invest, what would you do with it? Would you pay down debt? Would you buy stocks or ETFs? Individual stocks topping the list again. That shows there's an appetite for risk with extra discretionary income. But when we ask them, what are you kind of buying and holding on a pattern basis, regularly, it's mostly ETFs with some individual stocks. You saw the group of those individual tickers, but we also asked them, what ETFs do you hold? And they own the biggest ETFs in the market. So they have a duplicative portfolio in the big ETFs, which have these big stocks, and in the individual stocks they own. That is not abnormal. A lot of us have the same things. A lot of us own the biggest stocks plus the biggest index funds. So they're behaving like the rest of us, but they continue to be aggressive. And as we saw with global fund managers who got pretty bearish this year and backed off until maybe the end of the summer, individual investors have been mostly optimistic all year.
Here's another interesting thing you asked them. You asked them about policy coming down from the White House and how closely that is tied to the expected market outcomes.
Yep.
So what did you find out?
Yeah, so their trust in the markets has been waning, and that's because of a lot of the policy back and forth and tariffs, no tariffs, and I think they just don't understand where that is right now. But we always ask them this, no matter who's in office, they really don't care too much as long as it doesn't impact their portfolio. So trust in the administration waning, but belief that the markets will continue to perform well, at least 5% or more a year, that remains pretty high. So they're kind of not indifferent, but they're not going to stop investing because of what's happening inside the White House.
It's so interesting. I mean, you and I have been doing this for a long time, not to age the two of us, but it's so interesting in the past. I mean, really, it feels to me post-pandemic there was a bit of a change, both because of crypto and individual stock trading, where people felt like it used to be you invested in the market for retirement, for the long term. It feels now more that there has been something of a shift, reflected perhaps in that $10,000 going into individual stocks, that you can get rich. It's not just about investing for the long term, it's about maybe that lottery ticket.
You make a great point, because as you know, Investopedia also puts a price tag on the so-called American dream. What are reasonable expectations? How much would that cost to live that? $5.1 million right now. A lot of people are looking at that, especially younger investors, and saying, I don't see how I get from here to there.
Wait, 5.1 million measures what?
Measures the price of the American dream in what people think is reasonable. So owning a home, sending a couple of kids to college, having good health care,
like over time,
an annual vacation, right, over 40 years, over your lifetime. You don't need it today, but over your lifetime. They look at that, and they look at the fact that the median income is $80,000, and they say, how am I going to get to $5 million? Investing is one way, but they also see, and it's this convergence of trading, right? It's predictive markets, sports betting. It's all slamming together, that maybe a way to get wealthy fast is to buy the right stock or buy the right crypto. So the trading aspect is in there. If it brings people into the market as long-term investors, fine. But sometimes we know people get burned when they try to make a fast buck.
Yes, it's not always easy to do, people discover. Thank you so much, Caleb.
Thank you.
Good to see you. Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Really 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets. Taking a look at the major averages here, we continue to see a mixed picture, with the Dow really diverging from the NASDAQ today. The Dow up by about 1% here, the S&P 500 down 0.25%, the NASDAQ being dragged lower by Oracle. It's off by almost 1%. As we mentioned, Oracle shares, they are sharply lower a day after the tech giant reported disappointing cloud sales and a jump in spending on AI data centers that spooked investors. Let's go deeper into the Oracle story with Gil Luria, DA Davidson, head of technology research. Gil, it's great to see you have been raising these flags. I mean, you're not alone, of course. There's a lot of concern in the market about Oracle. But I know you talked about what Oracle needed to achieve in this earnings report and on the call, and it looks like it didn't necessarily do that. So, I mean, what was the big sort of disappointment for you?
Well, first of all, they missed. That's never good. They set expectations, they didn't meet them. They set lower expectations for the next period. That's never good. But more importantly, they have this tightrope they need to balance right now, which is they have this huge commitment from OpenAI that they need to build capacity for, that they need to borrow money for. But what's become clear to everybody else over the last 3 months is that OpenAI can't possibly live up to the commitments that it's made to Oracle. At the time, OpenAI had only committed the $300 billion to Oracle, which looked like a lot, but it looked doable. Since then, OpenAI has committed another $1.1 trillion to everybody else, which means that none of this is tenable. So Oracle has to still report over 500 billion of remaining performance obligations of backlog, when in fact everybody knows that 300 billion of that is phantom, because there's no way OpenAI can live up to that. While at the same time, Oracle needs to build out this capacity because they have a contract with OpenAI that says that they will. They don't have the capital to do it, so they have to borrow capital. They're still borrowing at investment grade, but they're very close to the threshold where they won't be able to do that. So they have to balance all these things. And the hope was that on the earnings call yesterday, they would be able to tell us how they're going to do it. And they did not have answers. They gave us some partial answers and ideas of how they could possibly do it, but they didn't clarify really how they can balance all these things at the same time, and that's why there's so much disappointment today.
Gil, the folks who are still bullish on this stock, pointed to that RPO number, and they said, that revenue is coming. or even if it's not the entire amount of that revenue, it's substantially more than their existing RPO, right? So why are you so confident that that is a phantom, that that is a mirage?
Well, I think it stands to logic that OpenAI will not have $1.4 trillion to spend over the next 5 years, or that outcome is highly, highly unlikely. And if they don't have $1.4 trillion to spend, where in the line for the spending they do have does Oracle stand? We would argue that they're not front of the line. Microsoft is front of the line. Microsoft, who owns the biggest part of OpenAI, is front of the line. They'll get paid first. If there's something left over, I'd argue that Amazon is probably next. Maybe after that is Oracle, which is to say the $300 billion isn't going to materialize. Maybe a portion of it will. If OpenAI is able to raise $100 billion by the end of the year, they'll probably fuel their fire for another year or two. But if Oracle doesn't have $523 billion, they should just live up to that and say, hey, look, we've reassessed the contracts. And now that it's become clear that this isn't a contract that we are 100% guaranteed to get, we're going to adjust down that remaining performance obligation number to a more realistic point. I understand that that's tricky, but until they do that, they're reporting a number that everybody knows isn't real.
Gil, aside from that, kind of what choice does Oracle have? As you say, you're suggesting they should reset expectations, which would presumably cause an even bigger re-rating in the stock, which is the trickiness you allude to. But at the same time, when you look at their spending plans, for example, when you look at them chasing this market, it feels like they don't necessarily have an alternative because of the competitive landscape right now. Or do you say, well, they don't really need to be in this market as aggressively as they are?
Yeah, I think the way out they had yesterday, it's a very narrow way, but I actually think the way out yesterday would have been to say, we're not going to raise any more capital. We have capital, we're going to deploy it. As the customer continues to pay for it, that capacity, then we'll reassess to decide if we can borrow more and deploy more capital. That would have probably been the way out of this. Which isn't to say Oracle is in distress. There's a lot of conversation about CDS. Oracle isn't in distress. They have a core business that's very profitable. They can pay for the loans they've made. And by the way, if they build out capacity and OpenAI doesn't materialize, they'll be able to sell that capacity. This isn't a matter of distress. It's a matter of setting unreasonable expectations that everybody knows are unreasonable and sticking with them.
And sort of reflected that, you have a neutral rating on this stock. You do not have an underweight rating on this stock.
Yeah, because again, there is a viable business underneath all this story. There's a database business that's very high margin. It's declining, but it's very high margin. And then there's an OCI business, an Oracle Cloud business that is a good business that has tenant customers like Zoom Communications and ByteDance and is going to have a bigger role when TikTok USA is formed. That's a good business. And by the way, some of the AI Oracle Cloud business is an okay business. That's renting capacity to real customers like Meta and X that are credit worthy. So there is a good underlying business here. They just really need to manage this risk around OpenAI in a better way, which is to say, just reduce the expectations that this will materialize, or at least carve off a first year and say, first year we know we'll deliver this capacity, we know that they'll pay for it, and then we'll reassess.
Gil, while I have you, and while we're on the cusp of 2026, I'm curious to ask you what you're going to be most closely watching next year, not just when it comes to Oracle, but when it comes to your whole coverage and comes to the AI trade. What are the big things that sort of need to happen next year for all of this to keep working?
Really, it's the core is the technology. Are the models going to get even better? Are people going to use them even more? Are companies going to start integrating AI into their business in a way that adds value and isn't just a proof of concept? If the technology works, the demand will follow and the build out will continue. And especially for those large companies that are the healthy participants here, Microsoft, Amazon, Google, NVIDIA, they'll continue to do well. We worry less about marginal players like Oracle and CoreWeave and AMD and companies like that are participating in the edges of AI. At the core of AI is TSMC builds NVIDIA chips that sell to Microsoft, Amazon, and Google, so we can do the things that we do with AI. And as long as what we can do, it gets better and better with AI, those companies will continue to drive significant growth. So we're just focused on the technology and the very large responsible companies that are deploying it.
Gil, great to see you as always. Thank you so much.
Thank you.
Coming up, we'll go live to Capitol Hill as Wall Street heavyweights weigh in on crypto legislation. Stay tuned.
Welcome back to Yahoo Finance. I'm Brooke Topama. We're live at the NASDAQ here in Times Square. Let's get a quick check of the latest market action. We're about 2 hours into today's trading session after the FOMC meeting where we saw the Fed cut by a 1/4 point. And now we're seeing a bit of a mixed picture led by a few dynamics here that are going on. Not only that Fed rate cut, but we also got Oracle earnings that missed Wall Street's expectations. And that's bringing the NASDAQ lower today. If you take a look at intraday trading, the NASDAQ's moving lower by about 1%. That's against the Dow, which is moving higher about 1%. And then the S&P 500 down also about 0.3%. Now keep in mind the S&P 500 has had quite the gain year to date. It's up about 17%. And now we're getting more bullish calls from Wall Street. Even FundStrat's Tom Lee calling for the 2026 year-end outlook. In his 2026 year-end outlook, he's calling for the S&P 500 to reach 7,700 by year-end, driven by the Fed. He said the bull market is still alive, so keep that in mind. We're also getting other takes as well about where the S&P 500 could reach in 2026. Oppenheimer has the most bullish outlook, reaching expectations for it to reach 8,100. But let's keep this in mind. This is against a backdrop where these record highs have largely been led by AI. And one of the companies that really has seen such momentum year to date has been Oracle. Now, overnight, Oracle got a major hit on Wall Street. The company wiped about $100 billion in market value overnight into today's trading session, sinking the most since about the early 2000s. It missed Wall Street's expectations when it came about its AI revenue, and that really hitting the street today. And we're seeing that sort of trickle over into the NASDAQ as well. Taking a look across the board, some of the biggest names in AI are taking a hit today, and that includes NVIDIA, Broadcom, AMD, as well as Intel. Broadcom down the most, about 3.6%, mostly in the red across the board on the NASDAQ, where we do have some winners. Keep in mind, Costco is expected to report today after the bell, so keep an eye on that stock. It's only up about 0.1%, heading into that read after market close. We also have Netflix moving higher, up about 1%, but largely against this backdrop, mostly in the red. Now the Dow, on the flip side, mostly in the green here. We do have Walmart, JP Morgan, Verizon seeing a nice pop today, up about 4%. Also Home Depot coming off their investor day earlier this week, moving higher, as well as Johnson & Johnson. And so really we're seeing this mixed picture here. Also worth noting that Disney, after announced that partnership with OpenAI, the stock is moving higher today, up about 1%. And year to date, this stock has seen not too much movement. It's mostly flat, down about 1% year to date. And so seeing a pop today, but definitely not the best year for Disney, as many things are underway at that company as well. But once again, taking a step back, all three major indices seeing a bit of a mixed picture here as we make our way further into today's trading session, once again following that 1/4 point cut from the Federal Reserve on Wednesday. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves throughout the session.
Big bank CEOs are on Capitol Hill today. Meeting with senators on both sides of the political aisle. The chief executives are there to discuss crypto market legislation that could soon come to a vote. Joining us from Capitol Hill is our own Jennifer Schomburger. So what do we expect from all of this?
Good morning, Julie. Senate Democrats have been meeting with Senate Republicans here in Senate Banking Committee Chairman Tim Scott's office for about an hour as they try to work out sticking points over this overarching crypto legislation. The goal is to try to have a vote in the Senate Banking Committee by next Thursday, but it's unclear whether they will meet that goal. I caught up with Democratic Senator Kirsten Gillibrand. Take a listen to what she had to say.
Good to see you. Good to see you. What are your expectations for this crypto bill? Continued bipartisan negotiations. Do you think we could get something done by next week? I think it needs more time, but I'm going to work as hard as I can. Thank you.
Now, Democrats are concerned among many issues, including that they believe that there need to be guardrails on the ability for crypto to raise capital, just as there are for stocks. They also want loopholes closed on illicit finance and terrorist financing, and they also want greater limits on elected officials' ability to issue digital assets and profit off of them while they're in office. Now, later this afternoon, over at the Capitol, bank executives from Bank of America, Citigroup, and Wells Fargo are all expected to sit down with senators to talk about this bill. JP Morgan CEO Jamie Dimon is unable to make this meeting due to a scheduling issue, Yahoo Finance is told. But one of the major points that bank executives are concerned about is earning interest on crypto. So we will be keeping an eye on that meeting and the viable path for this legislation as this afternoon progresses. Julie?
Look forward to updates from you on that front. Thanks, Jen. Coming up, why one expert thinks AI companies could get away with charging quite a bit more for their services. We'll be right back. GE Vernova sits at the center of a massive global energy build-out. I talked to CEO Scott Strazik about how he is steering the company through this next phase.
If you look in the U.S., over half of the electrons every day in the country are created with our equipment. So, wow. I mean, our install base is a very material part of the system in totality. In the world, it's about a third if you exclude China. So I give that context to just say we're playing to all industries and supporting all long-term dynamics. Today in our backlog, only about 10% of the backlog is hyperscaler, AI-centric. We could see that growing to approximately a third over the next 3 years, but today it's 10% of our business. At the end of the day, there's a lot of other drivers with demand right now. It's also just the electrification of buildings. It's the reindustrialization of the U.S. A lot of industrial growth outside the U.S. Ultimately, the electrification of transportation. So there's a lot of drivers. AI is one of them, but it's one of many.
Okay, so that's helpful to understand the bigger spectrum. Within gas turbines, though,
yes,
it's a higher concentration, right?
It's about a third.
Okay.
It's really about a third of our future business from here. This quarter, as an example, we've signed large contracts in Vietnam, in Mexico. So there's other, certainly international markets. Think about Saudi's been a very big market for us with gas the last few years. Taiwan, which in some ways AI-centric because it's powering TSMC growth that ultimately is related to the data centers. But if you really say just hyperscaler direct or nearly direct, it's about a third of our business in gas.
So even if you're looking beyond the hyperscalers to that bigger spectrum that you're talking about, you know, obviously you're well aware of the big debate around the spending that is going into compute right now, AI
Yes.
compute. So it can be a double-edged sword. It's great for your business,
Sure.
but there are concerns about overcapacity and cutting back. Are you concerned about that at all?
Well, I start with what we're seeing in our operations. And the reality is part of how we're expanding our margins as much as we are, and you know, we talked about with our investors yesterday, is 8.5% EBITDA margins this year, growing to 20% by 28. Part of that is the variable cost productivity we're driving with a lot of volume growth and limited, as an example, engineering growth. And that's because of the investments we're making in AI and the productivity we're seeing. So when I take a step back and think about a $130 trillion global economy and half of it's labor and services in one way, shape, or form, if AI impacts 10% productivity of that labor, that's a $6-7 trillion annual benefit. And I hear a lot of debates on hundreds of billions of dollars of investments. My point is just, I think it's early and see a lot of attractive returns with what we see inside Vernova and generally with all of our interactions with the hyperscalers. So I remain confident in the build. And frankly, we're probably capacitizing for a smaller demand than what many of us read about it could be.
I want to ask about the wind business as well, because this is the lagging part of the business that's not doing as well right now. Part of that is policy related, right?
Yes.
The Trump administration and President Trump himself is not a wind guy.
Yes.
I think it's fair to say. So is the focus in that business going to be mostly international? At some point, do you say, why do we stay in this business? Do you figure out a way to get out of it? How are you thinking about that?
Well, you control what you can control. And the reality is we have 57,000 wind turbines globally creating electricity today. That already gives us a real opportunity to invest into how we service those wind farms and to get the most performance out of them. As an example, we have 30 gigawatts of wind turbines in the US that are eligible for repowering by the end of the decade, where you kind of leave the tower, but you may put on longer blades, a bigger generator. That's very attractive because the wind farm already is there and you can just replace parts and get more output.
And you don't have to get approval for a new project, for example.
Exactly.
Okay.
The permitting is more straightforward. So you focus on what you can control. And those are examples of what we focus on today while running our business better. So what I talk to the teams about all the time is we're not going to play victim. We're not going to suck our thumbs. There's always going to be different administrations that may focus on different electricity sources in different ways. We need to use this period that you're right, our volume is softer, but do we run away from that, or do we use that softer period of time to build a better business? So as an example, we've implemented a lot more automation into how we make the blades. We've added a lot more robotics and inspections to drive a higher quality product at the end of the day. In this regard, it's easier to do that when our volume is lower than it would have been to do in a spiked period of time. So through every business model and cycle, you need to take it for what it is and make it better, and that's what we're trying to do.
And finally, I want to ask you a little bit about M&A. You guys just, your most recent Prolec, a maker of transformers, so another bet on electricity, and you bought the 50% of that you didn't already own.
Yes.
How does that fit in, and then how are you thinking about M&A as you go into 2026?
Yeah, I mean, we're really excited about the Prolec acquisition. To your point, we know the team well because we already owned 50% of the JV. There's large factories in Louisiana and North Carolina and Wisconsin that we see real opportunities to invest into to create a lot more output for the North America market. It just became a dynamic where we were doing more and more complicated deals with customers like the hyperscalers that were becoming commingled between, as an example, our gas and nuclear equipment and the grid equipment, and having to contract the transformers in the US with a 50-50 partner was maybe clunky. This streamlines the customer experience and allows us to invest into the factories in a way that maybe our partner didn't want to, because we're that committed to this market and believe in it. So,
and for next year, do you see any areas where you could see more opportunities like that, or other places that you would want to add on?
We certainly have a lot of capital to put to work. So what we talked about with our investors yesterday is we'll generate $22 billion of free cash flow after investing $10 billion of CapEx and R&D from 25 to 28. And then after we return at least a third of that $22 billion to our shareholders, that's $16 billion to put to work. So we need to focus on returns, figure out where we want to allocate that capital, but generally speaking, it'll likely be in our core. We talk about vertical integration, doing things that make the job easier for our teams than necessarily adding another ball in the air for them to juggle right now, because our teams haven't experienced this much organic growth, most of them in their careers.
Right.
So I want to make sure as I use our owners' money, I'm doing it in a way that my teams feel like we're making it easier for them to win and not more complicated. And that's where things like Prolec make a lot of sense, because it streamlined the customer experience. It allowed us to just integrate products that are similar to ours fully into our operations. That makes the team's job easier, and I think the customer experience better. Where we can find more of those opportunities, we're going to do it. But we're also going to be patient. We're not going to be rushed. And when we find the right transactions, we'll jump.
Great. Scott, thank you so much for being here.
Julie, thanks for having me again. I appreciate it.
Thank you. Oracle shares under pressure as concerns mount about the company's AI build-out plans, increasingly funded by debt. My next guest says the companies that provide AI tools could actually be charging significantly more for their services as use of these tools drive productivity. Tomasz, Tunguz, Theory Ventures founder, is joining me right now. Tomasz, thank you so much for being here. Appreciate it.
Pleasure's mine. Thanks for having me on the show.
So let's talk. I want to talk, first of all, a little bit about Oracle, and then get into that recent blog post where you talked about how much people could be spending. Oracle didn't seem to reassure the market about its spending plans. And as somebody who has invested in a lot of early stage AI companies, you're in venture capital, you think a lot about these big issues. How are you thinking about Oracle's approach and how the market is reacting to how it has approached things?
Well, Oracle's been very aggressive, especially for a company of its size and market cap, right? So if we look across the hyperscalers, they're among the smallest, and I'm talking about Amazon and Microsoft. The other dynamic here is the total amount of CapEx as a percentage of cash of Oracle is significantly larger than both Microsoft and Google. And so Oracle is building out a lot of these data centers primarily with debt, and they're spending roughly the same amount of money, order of magnitude about 100 billion a year, 30 billion in the last quarter on building out these data centers, and they're smaller. You also can see within the credit default swaps, which is a measure of the probability that the company will default on debt, their credit default swaps are trading at 3 times plus that of Google and Microsoft. So the market is perceiving some significant risk here. We could argue that the market is saying this is a way of betting or at least hedging against a fall within the AI data center build out, or we could say it's probably more company specific. And in this case, it's probably more company specific, primarily because they came up a little short on some of the numbers yesterday, and there is extra capacity. And there's 2 different ways of looking at extra capacity. One is the demand is not coming online as quickly as they thought. Or the other is that they're actually ahead of their contracts. And the remaining performance obligations, which is the contracted revenue in the future, has surged, but it's unclear when that revenue is coming. In contrast, Microsoft in the most recent earnings announcement said that the average duration for their RPO is about 2 years, but we don't have any visibility into Oracle's RPO duration.
Well, and not
all
just
of that to say,
yeah, go ahead, Tomasz. Sorry.
Go ahead. No. All of that to say, I mean, for startups, all of this is great, right? As long as there's more GPUs and ability to drive inference and experiment, and people with big balance sheets and ability to borrow can build these data centers, that's a really good thing. The downside would come when there's some miss or significant change in the fundraising environment.
Well, and something that one of our guests raised earlier about Oracle in particular is its reliance on OpenAI, not exclusively, but pretty heavily, and questioning whether not just the timing of that RPO, the remaining performance obligations, but whether they will ever come to fruition, given the lack of revenue through the door at OpenAI. So the fundraising question, I guess, goes to OpenAI as well, whether they'll be able to fundraise enough to continue to meet those obligations. And from inside that startup ecosystem, what is the kind of perception of that when it comes to OpenAI?
Yeah, I mean, I think OpenAI revenue is growing really fast. The projections are quite aggressive in order to hit many of their goals. And so we will see. I think there's a lot of confidence in an insatiable demand for inference. And we see it inside of our venture capital firm, and we were spending hundreds of thousands of dollars a year on inference. And we don't expect that to decrease anytime soon because we're automating so much work. So what the numbers will ultimately be and where OpenAI hits, I don't know. But we know that many of the existing data centers and the GPUs that are serving both startups and large companies have sold out all of their capacity for 2 or 3 years, which means that here there's at least plenty of demand so far.
And has fundraising slowed down at all?
No. In fact, I'll make 2 comments on this environment, and just going to a point that you made on the previous question. One of the dynamics in this environment is the customer concentration is remarkable. So you mentioned the Oracle OpenAI revenue concentration. We can look at NVIDIA with 2 customers representing about 45% of revenue, 4 customers representing more than 60% of revenue. Within startups, we often see it's very similar. These startups grow incredibly quickly, but many of them are serving the large labs, and they might have 1 or 2 customers that represent the majority or the supermajority of their revenue. And we ran an analysis comparing this to the .com era and the build out of networking infrastructure. And it turns out for NVIDIA, at least, there's 10 times more concentration in their customer base than, say, Lucent.
Wow.
So these startups grow really fast, and there's significant customer concentration, which introduces more volatility risk. If a customer reduces their spend with, say, a large inference provider, you could see a big shock to expectations. Now, we haven't really seen that within the public markets. We have seen some instances of it within the private markets. But I will tell you, I mean, I've lived through 2008, 2016, 2021, all of these bubbles, and the number of startups, seed stage companies, so a team of 3 to 10 people raising with an idea at $1 billion valuation, raising hundreds of millions. It happens 2 or 3 times a week now, and I've never seen that before.
So is it a bubble then?
It is. I mean, I think it's, Carlota Perez is this professor at Columbia, and she has a great book on bubbles, and she talks about the 2 different phases of bubbles. There's the infrastructure build-out phase and the commercialization phase. And this happened with railroads, and it happened with telecom, and it's happening now with AI. The interesting thing is that in those previous eras, there was a latency, a lag between the infrastructure and the revenue, right? So in 2000, the Amazon went public, it crashed, and then only now is it worth $3 trillion. What we have with AI is we're building out the infrastructure at the same time that we're seeing businesses grow at absolutely spectacular rates. And so there's an argument that like every technology cycle, we're seeing a compression in the duration of that cycle. So in a sense, will we overfund? Will capitalism overfund the development of data centers and different ideas? Absolutely. Are we seeing an absolutely tremendous impact on overall US GDP? We estimated this year it's about 1.6. Next year is about closer to 3. Just to put that in perspective, the railroads in 1860, which was the largest infrastructure project as a percentage of US GDP adjusted for inflation, was about 7%. And so current course and speed, could we see something that approaches 7%? I think we could.
Wow. Hello there. Welcome.
We have a special guest.
Tomasz, I just have one more question for you. And this has to do with what you recently blogged about, where you sort of extrapolated how much these services are worth, how much these LLMs are worth. And you kind of said they're not charging as much as they are worth, as much as they're worth to companies. So as in layman's terms, and as briefly as you can, walk us through that.
Absolutely. So most of the time, a piece of software might, let's say a piece of software saves a company $100,000. Many software companies are able to charge about 15 to 20% of that. But a lot of the productivity software across Microsoft and Google are charging single-digit percentages. And so if we can, I would say that there's a pretty significant pricing power here, and that's substantiated by OpenAI studies saying that they can save the average worker about an hour per day.
Right.
So we ran an analysis looking at what the average worker makes and what that's ultimately worth, and it suggests that they could probably double prices across all of these different products and still have a reasonable ROI, return on investment.
All right, we got to leave it there, Tomasz, unfortunately, but hope to talk to you again soon. Thank you.
Thank you.
Stay tuned. We'll be right back with Jared Blickery and Stocks in Translation.
What if I told you one of the best ways to judge today's bull market was invented before the Fed, before ETFs, and even before the S&P 500? Charles Dow, co-founder of the Wall Street Journal and the name behind the Dow Jones Averages, laid out a simple idea more than a century ago called Dow theory. And on today's Stocks in Translation, we're going to use it to show why this market still looks strong and how you can spot the cracks when they eventually show up. So Dow theory is basically this. It is a way of using the Dow Industrials and the Dow Transports to confirm whether the market's main trend is bullish or bearish, up or down. And here are some of the basic points. It was born from Charles Dow's editorials in the Wall Street Journal over a century ago. He never wrote a formal rule book, but later analysts pieced together about 250 of his columns and turned them into what we now call Dow theory. His big insight was to compare the averages of the companies that make the stuff, the industrials, with the companies that ship the stuff, the transports. When they're both going in the same direction, that is confirmation. And when one starts to diverge, that's a warning that a bigger change might be underway. And he was judging the market's big tides, not every little wave. He talked about primary trends that lasted years, secondary pullbacks that lasted months, and short-term noise that we mostly ignore. But regardless of the time frame, we use a very simple definition of trend: higher highs and higher lows for uptrends, and lower highs and lower lows for downtrends. And finally, Charles Dow would also look for volume confirmation in the averages. But Because of the rise of electronic trading, ETFs, and other factors this century, we tend to see higher volume these days when indexes sell off. So it's probably best to ignore volume at the index level. With that in mind, let's look at some charts. And here I'm going to start out with a 5-year look of the Dow Industrials, that's in purple, and the Dow Transports, which is in light blue here. And what you'll notice is that the Dow Industrials are up quite a bit more, up about 62% versus 39 or 40% for the Dow Transports. You also might notice that the Dow Transports are just testing their record high from late 2024, about 1 year ago. But here's what I want you to notice. While the Dow Industrials largely were in an uptrend from the third quarter of 2022, during that same time frame, the Dow Transports were stuck in this sideways range. And they actually started to break out of it in late 2024. That's this little oops that we're looking at right there. But then they sunk back below. And I'm going to zoom in on this time frame with a 2-year chart, and I'm going to show you how this was a great warning sign. So here in purple, we still have the Dow, and so it made a record high here, came back, pulled back, and then it was testing its record high. When that happened, the Dow Transports could only get about halfway back up. Then they proceeded to sell off, test that little high again, and then they broke this low right here. And in fact, the Dow Transports and the Dow Industrials were both breaking their lows at about the same time. But you really had a pretty good warning in late January, early February that something was amiss in the markets and that we might have a downturn. Were we predicting that tremendous post-Liberation Day sell-off? Absolutely not, but we were expecting perhaps some kind of market decline. Finally, I want to show you what things have looked like since that April 8 bottom. That's when things really turned up. That was 171 trading days ago. And here you can see the transports have actually pulled ahead. They're up almost 40% here, and they really only broke out of this long trading range very recently. And so with this very long base, it reminds me of the slogan in technical analysis, the longer the base, the higher in space. And that's exactly what we're seeing right here. So both the Dow Industrials and the transports are making new 52-week highs right now. And that brings me to my summary conclusions here. How exactly do you use Dow theory yourself going forward? Now, since both indexes are currently in uptrends and making new 52-week or 1-year highs, we're only going to cover the bull case here, but the bear instructions are simply reversed. So first, are both averages in an uptrend, making higher highs and higher lows? Or is one starting to flatten out like we saw a year ago? Then when one flattens out, you might actually see it break its major low. This is a kind of change that leads to a bearish trend change. So that divergence can be an early warning sign like late 2024. And do both keep making new 52-week highs, or is one only pushing higher while the other tends to chop sideways? And finally, can you look at the breadth of participation inside those indexes? Are a lot of transport names and industrial names participating in the move, or is it just a handful of stocks pulling the averages higher? Price action always rules the day as only price pays, but low participation can be an early warning indicator of a potential trend change. So putting it all together, things are looking bullish as we wrap up a year full of surprises. And when the story changes, Dow theory won't call the exact top, but it will tell you when the big tide has started to turn. And tune into the Stocks in Translations podcast for more jargon-busting deep dives. New episodes can be found on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. Stay tuned for more market catalysts.
Synopsys topping fourth quarter expectations with revenue up 38% year over year. The chip design software maker also expecting to set another revenue record in 2026. Joining me now, Sassine Ghazi, Synopsys CEO and President. Sassine, it's great to see you. Thanks for being with us.
Good to see you, Julie.
So you saw that revenue increase. Your increase in the backlog, I believe, was 13%. And you and I talk periodically about AI as a percentage of your business and how it has been creeping higher. So talk to me about where you are with that now. It's been a few quarters, I think, since we've spoken. Talk to me about where you are with that now and what the demand picture looks like.
Yes, so as you know, we provide essential solutions for the companies who are building either AI chips or AI systems, and that's where the contribution of our growth is coming from. As you mentioned, we had a record revenue year in FY25 where we crossed $7 billion, And looking ahead at 26, we guided at the midpoint at 9.6 billion, with a significant backlog entering the year at 11.5 billion. So the opportunity is driven by the essentialness of the solution we provide for the AI build out, not only in infrastructure, but all the way up to the application level.
And when you look at the breakdown of end market, of where this stuff is going, it is AI, but it's also things like automotive and industrial. And I remember when we talked earlier this year, you thought that automotive and industrial might start to pick up spending plans towards the end of 2025. Is that happening yet? What are you seeing in those businesses?
So it depends at what level are you looking at it. From the semiconductor chip level, they were dealing with an inventory, they're dealing with the cycle, and we're seeing an uptick in the overall automotive, industrial, etc. But we're really operating in a tale of two markets from a semiconductor point of view. The one that they're building chips for AI infrastructure, they're seeing a significant growth. And the companies who are building chips for the rest of the market, it depends on which market we're talking about, that at different stages of the turnaround.
Gotcha. Okay. And something else big that happened for you this year is you guys closed on a big acquisition, buying Ansys. So that brings together your chip design software with sort of physical simulation and testing in the form of Ansys. And for people who are at home who are not sort of really well aware of what all of this means, what does it mean in terms of common products that chips go into, an electric car battery range, a home computer and how energy is used there? What is this potentially going to change in those types of products and their development?
Yeah, in 2025, truly we redefined our company from a silicon essential solution to silicon to systems solution. So envision the products of the future: automotive, robotics, drones, aerospace, you name it. Those systems are going to become increasingly intelligent, AI-powered, natural language interface with your robot or whatever you're interfacing with. The complexity of engineering these products is going to require a rethinking, a re-engineering, a different approach to design these intelligent systems. And that's where Synopsys, with the acquisition of Ansys, we expanded our opportunity to provide that essentialness of engineering solutions from silicon to the end product. And all these markets I just mentioned are a Synopsys customer right now with the expansion of the portfolio.
And does it also mean that development is faster of those various products?
Thank you, Julie. Yes. So what will the end customer get is a ability to design the product more cost effective and on time, because there's no way you can deal with that complexity without bringing a different approach to design and engineer these products. You mentioned, for example, if you're designing an electric car, you want to determine the mileage on that car, the safety of the car. Instead of doing it through physical testing, you do it through a digital twinning, through a digital approach of designing these products and how they interact with one another. What is the capability that is possible to build? What does the next generation look like? All of this will be provided through our simulation and analysis portfolio.
And of course, digital twins. When you talk about digital twins, you got to talk about your partnership with NVIDIA, right? Because they help you guys do that. And of course, NVIDIA also invested $2 billion in Synopsys. Why did you all decide to do it that way instead of just doing a strategic partnership? Why make it that monetary connection?
So as you know, the relationship between Synopsys and NVIDIA existed from day one of NVIDIA, because what we provide to them at the silicon level is what enables their innovation. Now, as NVIDIA is talking about digital twin, physical AI, etc., they recognize that Synopsys is the leader from a solution point of view. And we've been talking to Jensen and NVIDIA from day one of the announcement of the Ansys acquisition. And that requires a significant investments from both companies to accelerate the delivery of that solution. In terms of the $2 billion, really the best way for me to think about it, it's an endorsement from NVIDIA. It was not the primary focus of the discussion. It was the collaboration, the technology, and it was a belief and an endorsement of the direction that we're heading. And we have an amazing balance sheet, as you know. But it's when a company like NVIDIA gives you $2 billion, you don't turn it down.
Fair enough, Sassine. Finally, everybody's talking about agentic AI right now, and you guys have talked about it as a potential tool to fuel chip design in the future. So if I ask you, what is a human engineer who works for Synopsys doing in 2030? What does that look like? What is the answer to that?
You know, we have these discussions every day inside our company. So AI is moving from a helper or an assistant to an engineer, where it's evolving to agentic, where what it means is the human engineer will assign tasks for the agentic or the agent engineer. And with that, you're able to expand the bandwidth of the human engineers. You'll be able to accelerate your product development. You'll be able to innovate in multiple other areas that today we're limited by the number of human engineers that we have. So I'm looking forward for that technology to be in full adoption so we can expand our bandwidth.
It'll be interesting to track it as it goes along for all of us and how it changed all of our work. Sassine, it's great to see you. Thanks so much for being with us.
Thank you, Julie.
That's it for Market Catalysts. I'm Julie Hyman. Thanks for watching. More Yahoo Finance coming up.